When are interest rates going to go down? So that's the big question of 2024. In December and again in January of 2024, the Federal Reserve made some comments that they were going to stop raising rates for 2024. This means that the last 2 years that they've been historically increasing the overnight federal funds rate, they are going to stop. And that this year, 2024, it's expected almost for sure that we're going to have 3 decreases in the overnight federal funds rate. Now, I say that because what this video is going to go over is, number one, it's going to explain that the rate that the Fed is talking about is not necessarily interest rates, although they're correlated, the mortgage interest rates. We're also going to talk about what is happening. When are the rates going to go down? When are people going to see relief? I'm Jen Hernandez. I've been a lender since 1995. I've helped thousands of people. And here on my channel, if it's your first time, I like to make complex topics really easy. So please comment, like, ask me a question. I'd love to hear it. Let's get started. So after the Federal Reserve talked in December, it was possible that they were going to start lowering the federal funds rate in March. Now, then in January, they came out and said, hey, we're not going to quite do that exactly yet. And now it's estimated that it's probably going to start in the May meeting. Now, there's many meetings through the end of the year, so the thought is that it's going to stair-step some reductions through the end of the year. So what does this mean for people? It means that there will be some relief. Now, really quick, I want to dig in and just say what this rate is that you're hearing when they say lower. So the federal funds rate controlled by the Fed is the rate at which big banks, any banks really, borrow emergency funds overnight. So banks are doing business all the time. Listen, they withdraw their accounts all the time, and they need quick emergency loans to cover that. So the federal government gives them a loan, and that's what the federal funds rate is. Now, it's highest than it's been in a very, very long time. So in my 28 years that I've done this, I actually haven't seen rates this high since like 1999, 2000. So when they say that they're going to lower or higher or increase this federal funds rate, they just say rates. So everybody thinks that these are the mortgage rates. So that is actually not the case. However, the mortgage rates are most closely resembled in the 10-year Treasury yield. Now, I'm going to put a chart up on the screen that shows you that the 10-year Treasury bond that sits in the bond market, you can see that it correlates up and down together. So if you wanted to see what rates are doing, then you should go to any, wherever you look at rates, wherever you can find bond rates online. It's in a lot of places. And look for the 10-year Treasury yield and see if that's going up or down. And that's going to give you an indication of what mortgage rates are doing. So when mortgage rates are determined on a daily basis, these investors, these big mortgage companies, are getting information from the stock market and the bond market and saying, how do we feel about the market today? What are we doing? What's going on? So it's about a feeling, and it's about a gut feeling of investors of what they think the market is doing is what drives interest rates. That's the best explanation I can give you. Now, back to what's going on in 2024. Again, we're talking about when will mortgage interest rates actually go down. So the Federal Reserve decided, hey, inflation is getting under control. It's not as low as we want it, but we realize, this is what Federal Jerome Powell pretty much said almost directly, we feel that these high rates that we have is not necessary anymore. It's actually having a more harmful effect on people than it is a positive effect. Yay! Let's just all clap for joy. So that's why he indicated, like, hey, I'm going to stop raising and we're going to start lowering because everybody needs relief. Banks need relief. Credit cards need relief. Car loans need relief. So that is why that is starting to happen. Now, a lot of indicators, a lot of, gross domestic product and labor numbers, all of these things are actually going strong. The economy is actually in a pretty good place. Now, some sectors of the economy, not so much. I know we're all feeling it in our wallets that everything is more expensive. But for the most part, what the indicators show is that the economy is doing pretty good. But it needs to do better by consumer confidence about these rates going down. And I think that the Fed realizes this. And really what I perceived from all of his statements is that they're really worried about the labor market, because if the companies that are borrowing the money from the banks that have the higher rates, remember the federal funds rate starts at the bank level. That's how they're borrowing emergency funds. So if banks have to pay more money for rates and for money, then they pass it down to their customers. Well, small business owners and companies are clients of banks, right? So then they have to charge more money and they have to pay more money. So if they're making more profit, what do you think they're going to do? They're going to hire more people to help them, because now they have a little bit more profit and they can help the labor market. They can help employment continue to grow. It's kind of like what I call the trickle down theory. In addition, it goes without saying, it's been said many, many times over history, that the housing market really does fuel the economy. And I personally think after 28 years of watching the Fed and what they do, they know this. So on a national level, the Fed knows that when consumers are not feeling good about where they live and not being able to live, like that's like a basic necessity. It's like milk and bread. You have to have it eventually. Like people need a place to live. So when people feel better about the economy, they feel better about being able to be in a home and having all their things, well, that spurs the economy, right? You buy a house, you go to Walmart and Target and Home Depot and you buy things, and that is what keeps the economy going around, just these basic things. This all goes also and collectively, I'll put some articles down in the notes in the description. There's job cuts everywhere. I know what a lot of people are thinking. I watch a lot of podcasts, and I think that if you watch enough things and read enough articles, you're going to go find whatever it is that you want to find. But right now there's big companies that are cutting jobs. Pull open Yahoo Finance or CNBC. UPS had job cuts. Citigroup had job cuts. I'm going to put these articles down below. So it is very much a real thing. On one hand, the Fed is saying the economy is doing well, but on the other hand, we see that there's job loss and people are struggling. Like I talk to people every day that just want basic things. Like, I just want to own a house. It is true that the affordability gap is the largest that it's ever been, that people can't necessarily afford a home in the area that they need or want to raise their families. I think deep down, what all of this is signaling is that the Fed knows this. They're doing what they can, right? They needed to raise rates in order to tame inflation 2 years ago. Well, that's old news now. We're moving down the road, and now they have to start a downward trend. So what we're going to see this year, now it's estimated that as the companies start to be able to have better earnings, what's going to happen is that the bond market and the stock market are going to feel good. And this is where the mortgage rates lie. Now, it's estimated, I've heard some people talk, I like to watch Clear Value Tax a lot. He's got a great YouTube channel. I'm going to put that link down below. He's got a lot of great sound advice. If you're watching, thanks for all you do. He estimates that rates could be between the 5 and 6 range by the end of the year. Now, I certainly hope that that is true. I will keep you posted on the channel for sure. Please like, share, subscribe, keep watching. Let me hear your comments. I predict that by the end of the year of 2024, we will see mortgage rates with a 5 in the leading number, 5 point something. So let's see. Keep watching. Talk to you soon.